You want to invest in the stock market, but you don't know where to start. There are all these graphs, numbers, and ticker symbols. There's so much information coming at you so fast it'll make your head spin. Let's simplify it a bit and talk about one of the most popular indices to follow and why it could be a good starting point for you. In this video, we will cover the basics of the S&P 500. And while it won't be every single thing you need to know, it'll help you start to understand why this index is one so many people follow. So sit back, relax, and let's dive in. The basics. A market index tracks the performance of a particular subset of stocks, bonds, or other investments. The S&P 500 is a stock market index that measures the performance of 500 of the largest U.S. companies listed on the New York Stock Exchange or NASDAQ. Created in 1957, S&P stands for Standard & Poor's, a company that provided financial market intelligence data. Over the years, the S&P 500 has become one of the most widely followed stock market indices in the world. It's often used as a benchmark for the U.S. stock market as a whole, and many investors use it as a representation of the performance of the U.S. economy. One of the reasons why the S&P 500 is so popular among investors is its long-term track record of outperforming other indices. Over the past 30 years, the S&P 500 has generated an average annual return of around 10%, which is higher than most other indices. The breakdown. Now, let's take a closer look at how the S&P 500 is composed. The index is divided into 11 sectors, each of which represents a different segment of the economy. These sectors include technology, healthcare, energy, consumer discretionary, financials, industrials, consumer staples, real estate, utilities, materials, and communication services. The largest sector in the S&P 500 by far is technology, which accounts for around 27% of the index's total market capitalization. Market capitalization, or market cap, is the total value of a company's shares. Basically, it's how valuable the company is. As of the start of 2023, the top 5 companies in the index are Apple, Microsoft, Amazon, Nvidia, and Tesla. This is followed by healthcare at around 14% and consumer discretionary at around 12%. Unlike some other indices that weigh stocks equally, the S&P 500 is weighted by market cap. This means that the larger the company, the more influence it has on the index's overall performance. The S&P 500 is also rebalanced quarterly, which means that the index's components are reviewed and adjusted every 3 months. This helps to ensure that the index stays up to date with the changing dynamics of the stock market. Investing in the S&P 500. So this all sounds good and you're ready to invest in the S&P 500. Well, you can't actually invest directly into the S&P 500 stock index itself, because it's just a measure of the underlying stocks. But you can invest into an index fund or ETF that tracks or attempts to match the S&P 500. This is done to tie to the stock index's performance as accurately as possible. Think of an index fund as a single basket that contains hundreds of securities, bonds, and other assets. Index funds offer an easy way to diversify your portfolio because when you invest in an index fund, you don't just purchase one single stock. Remember, you want to be as diversified as possible so that in the event that a company collapses, it's not entirely detrimental to your overall portfolio. So purchasing an index fund lets you purchase a little bit of hundreds, if not thousands of stocks depending on the fund. ETFs, like index funds, allow you to allocate your money to a fund that comprises bonds, stocks, and other assets. Once again, they can be built out to resemble the index as closely as possible. But unlike index funds, which can only be traded once per day at the end of each trading day, ETFs can be traded many times in a day. They're traded in the same way that stocks are, so their prices can fluctuate throughout the day. The biggest benefit to using either index funds or ETFs is that they allow you to passively invest. Passive investing is a highly efficient but low-cost way to benefit from the S&P 500 returns without being adversely exposed to the many risks associated with the stock market, and without trying to outperform the individual stocks that make up the index. Purchasing one of these funds is a simple process. All you have to do is sign up with a brokerage account. A brokerage account is a type of investment account that allows you to trade assets such as bonds, stocks, mutual funds, and ETFs. Once you have your brokerage, you decide how much money you'll invest and add the funds from your bank account. Why invest? Before you run off to create a brokerage account, ask yourself, what are the pros and cons? Why should you even consider investing in the S&P 500? The S&P 500 has proven time and time again to be a profitable strategy for long-term investments. It has historically averaged around 8 to 10% since its inception, according to Investopia. Imagine making 10% on your money without doing anything but letting it sit there. The S&P 500 also generally offers stability and diversification at a relatively low cost. Remember, it consists of the 500 largest, most successful companies in the US. So this comes with an inherent degree of balance across various market conditions. And as stated earlier, the S&P 500 is made up of many sectors consisting of a wide variety of industries. So when you invest in it, you're putting your money in each of those sectors, which immediately diversifies your holdings and reduces your overall risk and exposure. And the fact that you can typically do this without paying high fees or needing a lot of money is a plus. Now, we'd be remiss if we didn't talk about a couple of reasons why it might not be the best investment for you. Firstly, as with any investment, there is risk involved. This could come in the form of interest rates, inflation, or things like global or political events that can sway the behavior of investors and create volatility in the market. It can also be argued that the S&P 500 lacks mid and small cap companies. Since it's made up of large cap stocks, big company stocks, this generally makes it less volatile as an index. But it also removes the potential to take advantage of small and medium-sized companies. In addition, investing in the S&P 500 provides no international exposure. Because the S&P's selective structure restricts many international companies from being selected, international stocks, along with other equities, are left out of the index. So when you invest in the S&P 500, you're solely investing in the U.S. economy alone. There are many factors that should go into how and when you invest, including understanding your risk tolerance, your investment goals, and your time horizon. Investing is not a one-size-fits-all approach, so it's important to understand why and where you want to invest. Any type of investment carries risk, so consult a financial professional if you feel you need more information. Investing in the S&P 500 is a major way to build wealth for beginners and seasoned investors alike. When you invest in the S&P 500 ETF or index funds, you gain exposure to the world's biggest and most lucrative companies without having to spend thousands of hours researching individual stocks. So regardless of whether you decide to settle with the S&P 500 index fund or ETF, you can get a solid tool to access large cap stocks for your portfolio. Plus, you get exposed to the heart of the U.S. stock market and the U.S. economy at large. We always want to be clear that none of this is financial advice, but we believe looking at the S&P 500 could be a good first step for a beginner investor. It's relatively cheap, typically follows the broad market, and is naturally diversified. One thing is for sure, to have the financial future you want, you have to find a way to have your money make you more money. If you feel you don't have enough to invest, then check out our video on lifestyle creep to see if you can cut out unnecessary spending and expenses to give yourself the best shot at making your money work for you. Please like, subscribe, and hit that bell icon if you haven't already. Hope you learned something new. See you in the next one.